It's been a crazy week going back to last Friday, a week ago from Friday, and Jerome Powell's speech, which kind of affected and rippled through this whole week.
Right. It was a tough-talking speech that he gave a week ago Friday, where he basically said that the Fed would have to inflict some pain to counter inflationary pressures. And I think we saw follow-on activity this week. You know, it's a fairly light volume week. A lot of traders and investors are on vacation. But we did close on a fairly weak note. And in fact, for the week, the S&P was down over 3%, the NASDAQ down 4%, small caps also down 4%. So more profit taking from that very sharp rally we saw from the middle of June.
What seemed to be the major story was Friday morning when the jobs number came in, and for once it was pretty darn close to the estimate.
Yeah, the interesting thing is 26 of the last 30 readings on inflation have been better than expected. So that's a positive. And so in today's jobs number, remember last time the jobs number was very strong, which gave the Fed added impetus potentially to hike rates. This time it was more in line. There were some downward revisions. There was a moderation in wage pressures. So all in all, it was what some termed a Goldilocks report. But, right now the conditions are fairly thin. There's not a lot of liquidity. And there was also a good number on Thursday, the ISM Manufacturing Index. In that, the prices paid index, which is the prices manufacturers are paying for raw materials, plunged to 52.5, its lowest level in 2 years, which really is consistent with the CPI moving back towards 2% in the not too distant future.
Is that an input cost number? Is that
it is.
Okay.
And that's what we're looking for. We're looking for some moderation in demand, diminishing wage pressures. We did see that the number of people in the workforce actually expanded, which is why the unemployment rate ticked up to 3.7.
That's a participation number?
Right.
Yep.
Yeah. And so essentially the Fed is getting what they want. And, the thing I keep thinking about is a year ago, the Fed thought they'd raise rates once in 2022. Obviously, that was not the case. They've raised rates many more times than that. And you have to wonder, are they right about next year? Will we see the persistent inflationary pressures that they now seem to believe we will see? Perhaps inflation pressures will diminish more rapidly than they think.
I've seen just a few more mentions of the fact that the Fed could bring this thing in for a soft landing. What's your opinion on that?
Well, historically, they haven't done it. Really,
Right.
Only 15% of the time have they been able to do it. And two of the cardinal rules of investing are don't fight the Fed and don't invest in stocks when earnings estimates are coming down. And right now we see both of those things happening. The problem is that in order to anticipate or approximate a bottom, you almost have to act in advance of a trough in earnings and Fed activity, because the stock market will sniff that out long before those two things come to pass.
So I guess we need to figure out how bumpy of a landing this is going to be and how far forward we'll feel it. Is still the feeling that 2023 really is going to be quite a year and one that we could see a recession?
I think there is a possibility we could see a recession in 2023. The question is the magnitude. I mean, right now, the United States is in a much better place than Europe is. We hear constantly about natural gas prices, a very difficult winter there with inflationary pressures much more severe than we face here, which is why when I look at our portfolios and when we meet as an investment committee every Tuesday, we're talking about balance. We're about average in terms of our allocation to equities. Our fixed income allocation is modestly underweight. We're looking to add duration there. In other words, expecting that long-term rates will eventually start to roll over and go lower. But we're not prepared yet to go overweight in equities versus our targets.
There are 11 sectors. Any of them performing better? It looked like energy was going well for a while, but then kind of got knocked around.
Well, energy has done well all year. And in fact, energy dominates the free cash flow yield statistics. They've been able to add a considerable amount to earnings on the total S&P. In fact, with earnings from the energy sector, we would have actually had down earnings last quarter in the S&P 500, which many strategists don't seem to indicate.
So I would think that the next major thing that we're going to be watching is when the Fed meets, and that does happen in September. They took August off. 50 basis points, 75 basis points, nobody really knows. Is there any indication?
Well, this most recent jobs number might suggest they could go 50, but I think many people think they will go 75 again and then perhaps say, hey, we're making a little bit of progress of inflation. Let's watch the data. Let's see how persistent these inflationary pressures are, particularly as it applies to rent and wage growth. And then the other thing is that, We're looking at technical levels. We're around the 3,900 level on the S&P. Some say there's support between there and 3,850, which would be a retracement of the advance that would still constitute a healthy market. So, again, a balanced portfolio makes sense. Take a look at what you own. Make sure you're not over the skis in any particular sector and be patient because this may take a little time.